Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500. I look at other stock indexes. I look at sectors within the stock market, and I also look at other markets because all of these things act together, and sometimes we can get some clues about what's happening in the stock market by looking across a variety of different markets. The idea is to gain some insight that maybe we wouldn't get otherwise. This is being prepared for Tuesday, January 2nd, and incidentally, as I record this, I hope it's during a ceasefire of holiday explosions. That's the hope. We'll have to see as I continue to record this. If you hear some loud booms in the background, just take that as a Happy New Year's greeting to you. The first area that we look at is S&P 500 valuation. And we want to know what the current price of the S&P 500. Is it considered to be expensive? Is it cheap? Is it fairly priced? Well, there's a couple of different ways we can look at this. We can look back on what's already happened to get some historical data to see, okay, what was the market valued at during that time? And then what was the current price? Then we can also look forward, and that's what the market tends to use. We use forward-looking PE ratios, and I had to change that over the last couple of weeks to some different charts than what I was showing before. But this just gives us an idea. We don't necessarily use this to make decisions. We just want to know, is the market expensive, fairly valued, or cheap? Here is a chart looking backwards. And what they do is there's a thing called the PE ratio, the price to earnings ratio, and it's on a static scale. 10 and below is considered inexpensive or cheap. Between 11 and 19 is considered fairly valued. When we get to 20 or above, the market is considered to be expensive. And we see the red, blue, and green lines here. That's what the price should be if we were at that PE ratio. And then the black line is where the S&P is at right now. And then on the bottom, I take the difference between the S&P and the PE ratio of 20. When we're above this blue line, which is 0, that means that we're overvalued on a historical basis, and not necessarily surprising. And we can be overvalued for a long period of time. We can go many years. That's why we just want to use this as information. We don't necessarily make decisions based on this. We just kind of want to get an idea. We can also look at this in the context of different historical events that have happened. These are just some major things going back to 1980, and then over on the right-hand side is where we're at right now. Then Robert Shiller developed a different way of using the PE ratio. Instead of just 1 year at a time, he spreads it out over many years, and he's come up with his own way of looking at this. And you might hear this called CAPE, C-A-P-E. Well, the current reading is 32.27. To give us some context, we can look at a historical chart of what it has been in the past and where we are right now based on what the S&P 500 is doing. Also, to get some other context, we can look at the median and the mean, where we're just under 16 for the median and we're just over 17 for the mean. When we look at the current value, 32.27, that also suggests that on a historical basis, we are considered expensive. But the market doesn't do that. Based on analyst projections and forecasts, they come up with what they think a company is going to earn and then what the price of that company is going to be based on where it's at right now. And they configure a thing called the forward PE ratio, and that is an estimate. And right now, based on the S&P 500, we are at 21.36. So we're slightly above that 20 level, which would be considered to be slightly expensive. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high, and that's what most people want to do when they're buying stocks. Value may be longer investments or investments that you get into when the markets run into difficult times. Maybe you buy a stock for its dividends or because it's been around for a long time and it's more of an established company, and they tend to hold up better when we run into some difficult economic times. When the markets are really going up, growth tends to outperform value. Back in 2022, when the market was under pressure, value was outperforming growth. Well, what are we looking like right now? First, we look at a peer growth index, And this is just growth all by itself. And we are seeing that we've been able to establish a new uptrend. Then we look at a value index where it's just starting to cross over and give us a golden cross. So this is also looking positive. And this is one area of concern that I'll point out as I go through these charts. And if you watch the daily videos and weekly video that I do, there are some concerns right now where growth should be doing better than it's doing. We've got the stock market really going up, but growth is not really participating. And that's a bit of a warning sign for us. Then we do some ratios. We look at growth versus value on the top and then value versus growth on the bottom. They're calculated in a slightly different way. When we flip the charts around, we get a little different perspective, and sometimes we can see things that we may not have seen otherwise. The growth to value ratio on top, it is positive, but you can see going back to the latter part of October into the end of the year, this is about when the market bottomed, and when we've had a really solid up move during that time. Well, growth has not really been outperforming value during that time. Value has been outperforming growth when we look down at the bottom area. And again, not necessarily something that will happen right away because this has taken a number of months to develop, but something we still want to be aware of, and it's a little caution that we just want to tuck in the back of our mind. We also look at some growth of value looking at ETFs based on the S&P 500, and we're seeing pretty much that same thing, where growth is still in an uptrend, but for the last few months, it has been falling back. Here's an inverse of that same chart, where value's been underperforming, but has been bouncing back up. Then we look at some other indexes on a longer-term chart where we have been really showing some weakness here between this growth to value ratio, but we're still in an uptrend. But we're in danger of the blue line, the shorter term moving average, crossing below the red line, and that would produce a death cross. And then here's another look showing where growth is still outperforming value, but it's still in a longer term downtrend when we can look at value first and then compare it to growth. Then here's growth to value again, showing how growth has been in an uptrend, but pulling back recently. We look at some different measurements too, basing growth versus value, where it's still in a longer term uptrend, but it hasn't really been breaking out as the market has been breaking out. And here's where value has been underperforming and has been starting to turn up where you would think it should be going down during this time. We also look at growth of value for the small caps. We're going through a period right now, which up to this point seems to be what they call the January effect. Along about the middle part of December and then off into the new year, there tends to be a real favorable season for small caps. And they've been doing well. You can see the index up here. It had a down day on Friday, but it has really been going up since the latter part of October. But when you look down below, we're actually starting to cross below with a death cross when we compare growth to value for the small caps. Where we're seeing a little more strength is in the mid caps. And here's the index on top, as it's been doing quite well. And this is more of an uptrend. And it's actually was breaking out above this recent range, even though it pulled back in Friday's session. Then we look at the S&P 500 growth to value ratio. And this is what I focus on the most because everything I do is around the S&P 500. And as the S&P's been going up, we've been seeing the growth to value ratio going down. This may take some time to play out. It could come into play at any given time and be used as justification for the market to go lower. But in the meantime, this has been playing out and the market continues to go up. We also keep an eye on inflation. One of the areas that we look at is called the CRB index, and those are commodities. And on top, we have a monthly chart where it's pretty much been going sideways, but we're seeing some weakness lately. Commodities had really been going up and now they're leveling off. And if we're more in a deflationary environment, meaning that inflation is more under control, we would expect to see this to go down the way it is right now. Then to get another view on this, we look at inflationary areas and we take a ratio with deflationary areas, and we're below the moving average and we're not falling off a cliff here. Excuse me. When we're going down below the moving average, that just means that inflation is underperforming deflation. And you might think, oh, that's great. That means prices are going down. And that is good to a degree. But then you can get too much of it where deflation can actually be more damaging than inflation. So the idea that this has been coming back up a little bit lately just means that inflation is under control, but deflation is not out of control right now. We look at the CRB index, which had been in an uptrend, but it has been pulling back. If we continue to stay under both of these moving averages, we might end up seeing a death cross. And this is a daily chart. We also look at the Baltic Dry Index, which really started to spike up as we were having geopolitical issues, specifically in Israel. And this is what does it cost to ship products from point A to point B, specifically in the Baltics. And when this is going up, that probably means it costs more. When this is coming down, that means prices are easing. And we're still in a longer term uptrend here, even though we have been pulling back. Then we keep an eye on some other markets. These are just things that we look at to get an idea of where do we stand with different commodities. The first one we look at is aluminum, where it's still in a longer term downtrend, but it has been bouncing back up. We look at corn, which continues to be in a downtrend. Wheat has been bouncing back up, but is still in a longer term downtrend. We keep an eye on fertilizer, which had been really coming down. Then it started to bounce back up. It's now resumed going back down. Oil, which is something that impacts all of us, it's been chopping around a lot. When we saw this spike up and go to 95, that was when everything started to go kind of crazy in Israel. And since that time, it's been backing off and we're getting more down into the 70 range. Gas is something that affects all of us too, where we continue to be in a downtrend. We look at diesel, which is also going down, and that also helps prevent products that we buy from costing more because trains and trucks and things that have to ship those things, they're not having to pay as much to transport their products. Heating oil is also continuing to go back down and is still in a downtrend after it had been bouncing back up. Natural gas is also starting to go back down. Copper, this is a barometer of the economy. Typically, the rule of thumb is, we call it Dr. Copper, because when copper's going up, that means that the economy is looking more positive going forward. When copper's going down, that means that they see economic weakness going forward. And even though we're still in a downtrend, we have been bouncing back up over the last few months, and this could suggest that we're seeing more of an improvement in the economic situation. Then we look at the copper to gold ratio. When, as I said, with copper, that tends to measure what's going on economically. Gold is like this inflation hedge against insanity type of a thing. When things get really out of whack or weird things start to happen, that's when we see gold start to do better. But lately, copper has been coming down when we take a ratio, when we compare it to gold, and has been declining when we look at the moving average. Then we look at a long-term version of that same chart. The copper to gold ratio is the black line, and that has been declining as gold has been outperforming copper. And then we also look at the 10-year yield and the 2-year yield, and these are starting to come down too, as interest rates have been falling over the last few months. We look at gold, which is still in an uptrend, but it really isn't breaking out when we look at it with the ETF. Now, I know there are other indexes that have it well above 2,000. The ETF itself is still in the 1,900 range. Silver is still in a longer-term downtrend. It could generate a golden cross here soon, but it's been really choppy lately. And that's one of the frustrating things about precious metals is they can chop all over the place. They don't trend really well. Then we look at gold on the top at the closing price, where it's been coming down slightly. We look at silver, and it's also been coming down. And then on the bottom, we look at the gold to silver correlation. And most of the time, they have a real strong correlated relationship. But we've been seeing that weaken just a little bit lately. Then we look at the gold to silver ratio on the top. And then in the middle area, we have the dollar index. And sometimes these have a strong correlated relationship. But right now, they're actually going in opposite directions of each other as this relationship has been wearing off. We look at the dollar index, which had a pretty strong year. It was going up. Now it's been starting to come back down. It's still in an uptrend, but if we stay below these lines, we could end up generating a death cross. And if we see follow-through strength in the stock market, we'll probably end up seeing more weakness in the dollar to the point where we might even fall below the 100 level. We look at the euro and compare it to the dollar. That's this top area. And then I have breakout charts to show you. Up on the top, here's the Japanese yen to the US dollar. And here's the euro, where we have been seeing that the euro was underperforming, but now it's starting to come back as we've been seeing some weakness in the dollar. We're not quite there yet, but we could see a golden cross showing that the euro will continue, likely on a trending basis, to outperform the dollar. The Japanese yen has been bouncing back too, but is still in a longer-term downtrend compared to the dollar. The British pound also showing some improvement here, and we could see a golden cross fairly soon where the British pound would, on a trending basis, be outperforming the dollar. Looking at some other indexes, we have the S&P 500, which is a weighted index, and you probably heard of a thing called the mega caps, where there's like the Magnificent Seven. These are the really big companies, and whatever direction they move in, that impacts the S&P 500. Well, another alternative to that is called the equal weight index, where all of the stocks in the S&P 500 are treated the same. It's not weighted. And it had been underperforming as the S&P had been going up. That's the red line. But lately, we've been seeing a real improvement. Now, I have an additional chart here put out by Real Investment Advice, and this just shows that the equal weight index has been underperforming, but it is showing some improvement when we look at it more on a ratio basis. But it's the big S&P 500. It had a much higher return in 2023 than the equal weight index ended up having. Then we look at a ratio between the S&P 500, which are stocks, and the CRB index, which are commodities, showing that stocks are outperforming commodities. Here's an inverse showing how commodities are underperforming stocks. And then we look at the NASDAQ 100 and the S&P 500, and both have had really good years, but the NASDAQ 100 has had even a better year and has been outperforming. Then this is another area of concern. This is the S&P 100, which are the 100 biggest stocks in the S&P 500. And then we compare that with the rest of the S&P 500, and we're starting to see where the big stocks are underperforming enough to give us a death cross with this ratio. Now, we could take this a couple of different ways. This could be showing us some weakness, that we're seeing the bigger companies not perform as well as the rest of the market. That could be the negative side. The positive side could be, wait a minute, maybe we're seeing more of a shift where the broad market is starting to outperform some of the bigger stocks, and that could be more positive for the market. We look at the NASDAQ and compare it with the S&P 500. Both have been doing well, but the NASDAQ has been doing even better. The NASDAQ 100 and NASDAQ, which both had really good years in 2023, the NASDAQ 100 has done even better. Then we look at the mega caps, the Magnificent Seven, the really big companies, and compare it with the equal weight index and take a ratio showing how the mega caps have been outperforming, but you can see this starting to come down. Again, there's two ways to look at this. You could see it on a negative side by saying, uh-oh, the mega caps are starting to underperform, or you could take it on the positive side and say, okay, that just means the rest of the market is now participating. Then we do a ratio between the small caps and the S&P, and we're seeing some improvement here. The ratio is the red line, and that has been going up, and that's good. We like that because that helps give support to the blue line, which is the S&P 500. And to have them both going up is more of a healthy environment. Then we look at another ratio where the small caps have been underperforming the S&P, but they're starting to bounce back up. It's going to take a while still for this to generate a golden cross here, if that ends up being what happens. And then we look at the biggest software companies, and they've been chopping more or less sideways. They did go negative last fall, but now we've been seeing them bounce back up, and we're starting to see a golden cross here with these companies. And this is tech. We look at the mega cap growth stocks, which continue to be in a really solid uptrend, not quite back to their all-time high yet, but they're getting very close. We look at the robotics and AI ETF, which has been showing some improvement. Also, when we do a ratio between the AI ETF and the tech sector, we are seeing some improvement here after it had been really underperforming. Then we take the Dow Jones Composite Average, which is the Dow, the transports, and the utilities, and put them all together. We are seeing some improvement here. We're coming back to these previous highs. We're wondering if we can break out above that, and we're seeing a nice uptrend starting to develop. We compare the S&P 500 with shorter-term bonds based on 1 to 3 years, showing that stocks are outperforming bonds in the short term. Then we look at a broad market measure and compare it with further out bonds, also showing that stocks are outperforming. We look at low volatility stocks, which have really been chopping sideways. These held up much better in 2022. They may have been down, but they weren't down as much as maybe the mega caps were or the growth stocks were. We're seeing some improvement here. We're above both of the moving averages, but not quite enough yet to generate a golden cross. Then we do a ratio between the low volatility ETF and the S&P, showing that the low volatility stocks are really underperforming right now. We actually broke below these previous lows and we're in a downtrend. And this would suggest that the markets are favoring more of a growth environment. We look at the tech sector and compare it with bonds, showing that the tech sector is outperforming. And then we look at the S&P and compare it with other stock indexes. We have the advanced decline line studies, and I show this in each daily video. On the top, we have NYSE common stock, and common stock is probably what you buy. That's what most investors end up buying because there's different kinds of stock. Even though we've been declining, we're still above an advancing moving average. We're also looking pretty good with the S&P 500, the mid caps, even though they've been pulling back down, and the small caps. Recent weakness, but still looking stronger in the longer term. This is another concern. We have a thing called traditional Dow theory. You have the Dow on the top, you have the transports in the middle. I include utilities, even though that's probably not part of traditional Dow theory. But you can see where we've been breaking out with the Dow and we got beyond this previous high, where we have not been able to come up to this previous high with the transports, and we've actually been underperforming over the last few days. It gives the S&P 500 more support if the transports are outperforming the Dow, and that's not what's happening right now. We do a ratio between the transports and the S&P, showing how at best we've been chopping sideways, but we want to see this ratio going up, and it's been going sideways to actually down recently. So that's another warning sign. We look at the ratio between the Dow and the transports. It's also been chopping more or less sideways lately. And then we look at the relationship or the correlation between the S&P on top and the transports. Their relationship isn't quite as strong right now because we've been seeing some strength in the S&P, but we haven't really been seeing that same strength in the transports. And that's why this correlated relationship is actually getting weaker. Then there's a new way of looking at Dow theory, where instead of using the Dow, we use the S&P, since that may be a better representation. And then instead of using the transports, we use the NASDAQ because that's more tech, where we're not a railroad-based type of economy anymore. And mainly what we're looking for are negative divergences here, and we have seen those in the past. But right now, they're actually confirming each other, so we would call that a positive convergence. And then the FANG index has been chopping sideways lately, but is still in a longer-term uptrend. And this is Facebook, Amazon, Apple, Netflix, Google. And there's other stocks that are included in that. I just keep the name FANG. And then looking at a longer-term chart where we did recently just set a series of all-time highs, we have been going sideways to slightly down. If we see some weakness, we're going to be watching some of these areas here to see if they end up providing support. ARK is also showing some improvement. It still has a long way to go to get back to its all-time high, but it is in a longer-term uptrend. And then we look at a monthly chart of the S&P 500, and then we compare that with stocks in Europe, Australia, Asia, and the Far East. When we're above the red line and going up, that means the S&P is outperforming, and that's what's happening here. And then we can look at a momentum oscillator, the PPO, where it's still above zero. It's rolling over just a little bit as we were hitting some difficult times last fall. But if we see follow-through strength with the S&P, this momentum oscillator could start to turn and go back up. And we compare stocks with bonds. This is a total bond ETF. We're just about getting ready to see a golden cross here as we're seeing bond prices improve as interest rates are going down. The world bond index is also showing some improvement, but still in a downtrend. And we do a monthly chart of the stock to bond ratio. Even though this is rolling over, stocks continue to outperform bonds. Then we look at a shorter term chart showing how bonds are underperforming stocks. And we look at high yield corporate bonds, which you may also know them as junk bonds. They're doing really well right now. They're in a solid uptrend and coming back and at least testing the previous all-time high for this ETF. Then more conservative bonds are investment grade bonds, and these might be corporate bonds that you end up buying. We're just about getting ready to see a golden cross here. So we're seeing some improvement in this ETF. Then we do a ratio between riskier bonds and not as risky bonds. And for quite a while, folks have been favoring the riskier bonds because they give you a higher yield. Folks are willing to assume more risk to get a higher return. Well, this is falling off just a little bit now as we're seeing the overall market situation shift just a little bit. We may be getting into a point now where interest rates are going to start to come down. And then you would see folks probably get out of the riskier bonds and get more into the more conservative bonds to lock in a higher yield. Then we look at a stock to bond correlation, and we measure this down below. A lot of times they have a real strong tendency to go in the same direction at the same time. It has been weakening just a little bit, but they're still having a slight tendency to go in the same direction. We look at the corporate bond index. We're starting to see a golden cross here as we're seeing some improvement. And here's the 10-year yield where we got up a little bit over 5%, and we've been coming down lately. And the market really likes that. And that is giving justification that the Fed may end up lowering interest rates in 2024. Here's another measure of the 10-year yield going all the way back to 1980. We're kind of in between here wondering what's happening because we saw a 40-year period of time where interest rates were making a series of lower highs and lower lows as the overall climate saw interest rates going down. Then we started to spike out above that long-term trend, but now we're starting to come back down. So we don't know, is there a shift where we're going to go into a higher interest rate environment? That's what it was looking like. But now that we're coming back down with interest rates, we're wondering if that shift is actually going to take place. Here's the 30-year yield, which has also been coming down overall. We look at the S&P 500 and compare it with the 10-year yield, showing that stocks are still outperforming interest rates at the 10-year level. Here's the junk bond ETF, which is also continuing to do quite well, coming back close to its all-time high. And then we look at the junk bond to bond ETF ratio, showing that we're coming back down a little bit. This has been really outperforming. Folks were willing to assume more risk. Now that interest rates may have topped out at the government level with government bonds, we're seeing this coming down as folks may be shifting over into more conservative bonds. Then we look at the bond ETF for 7 to 10 years, where we're coming off of an extreme positive reading with the RSI. We're still in a longer-term downtrend, but we are starting to turn back up here. On a momentum basis, we had been positive through November and into December, but we could be seeing some weakness with the MACD. Then we look at a daily chart of yields showing how overall interest rates have been coming down. Here's a weekly chart looking internationally for the US, UK, and German rates. They have been coming down for the most part, and even Japanese rates, which are in red, they've been coming down as well. We look at the MOVE index on top, which measures the volatility of bonds. The VIX measures the volatility of stocks, and they're not really strongly correlated right now. In fact, they're having a tendency to go in opposite directions of each other. Then we look at a monthly chart of the price of the 30-year bond, where it has been coming down, but we're just starting to come back above this longer-term moving average. However, when we compare the price of bonds with the price of commodities, bonds longer term are still in a longer term uptrend. Then we look at different sectors and we compare them with the S&P. Materials are underperforming the S&P. Communication is outperforming. That was a stronger area in 2023. The energy sector, which had been showing some strength, is now starting to show more weakness. And we've seen a recent death cross here when we look at this ratio. The financial sector has been showing some improvement. In fact, after going sideways, we took a big dump back in March. That was the banking crisis. And then we went sideways. And now we're starting to see more of a new uptrend developing. And then the industrials continue to be in a downtrend compared to the S&P, but they have been bouncing back lately. The tech sector, another strong area in 2023, continues to outperform the S&P. Staples continue to underperform the S&P. Real estate, as we topped out with interest rates and we're starting to go back down, this really helps the real estate sector, and that only makes sense. It's harder to buy a house when interest rates are higher. But we're still in a longer term downtrend, and it's going to take more time for this to show more improvement. Utilities also closely follow interest rates, and they continue to underperform the S&P. Here's the S&P to utilities ratio. When this is going up, most of the time that means the S&P is going up. When this is going down, that typically means the S&P is going down. Right now, we've been chopping around, but we have been going up overall, and that's been giving support to the S&P. Healthcare continues to be in a downtrend compared to the S&P. Here's another look showing how healthcare is underperforming. Then discretionary, which has been going really sideways. It's still in an uptrend, but we want to see this really break out and go higher as the S&P has been going higher. And this is another area of concern. It was stronger earlier in the year, but then it just kind of ended up floating sideways. Look at the staples sector, which is still in a downtrend, but it has been bouncing back up and showing some improvement. The tech sector continues to be in a pretty solid uptrend, and we broke above these previous highs here. So that's looking pretty solid right now. The semiconductors are also doing quite well. And the tech sector, when we compare it to the S&P, shows that the tech sector is outperforming. Energy is underperforming the tech sector. These are two main areas that people like to get into. And so that's why I do a ratio chart of them. We look at growth, which continues to be outperforming bonds, even though they've been pulling back lately as we've been seeing some improvement in bond prices. Here's the tech sector comparing it to interest rates, where the tech sector has been starting to come back as interest rates have been going down. And then here's an inverse of that same chart showing how interest rates are starting to go down when you compare it to the tech sector on a ratio basis. Discretionary continues to outperform staples, even though we want to see discretionary doing better. When we look at this ratio, it's still holding up quite well. And then here's an inverse showing how staples are underperforming discretionary. Gold, even though gold has been going up, the S&P has been going up even more. So gold is underperforming the S&P. But when we compare gold to the dollar, it's starting to break out as we've been seeing some weakness in the dollar. High leverage loans continue to just keep going up in a really solid uptrend, and that generally means more favorable economic environment going forward. The NYSE composite is also crossing back over with the golden cross and showing some improvement, but not quite back to its all-time high, at least yet. Then we look at all stocks, which looks at the US as well as international stocks. They continue to do quite well and are coming back and testing this previous all-time high. Emerging markets are showing some improvement. They've been chopping more or less sideways, but they are starting to go back up now. Micro caps still in a longer-term downtrend, but showing a lot of improvement and going higher. This is all suggesting that things are turning more healthy with the micro caps, the small caps, and the mid caps. We look at the home builders ETF. We're not really seeing anything here. We have the S&P on top. We have the home builders ETF. And then we do some studies down here. We look at the ratio, and then we look at the correlation between the two. When they get really out of line with each other, that's when we take notice. So far, they're kind of going in the same direction. We look at Bitcoin just to keep an eye on that. It continues to be in an uptrend. We're getting up into the mid 40s or so for the high, and we're dropping back down into the 42,000 range. Then looking internationally, where China is starting to turn back up, as well as the emerging markets. We're still declining when we look at Europe, and Japan is pretty much going sideways, but we are seeing some improvement now with the US stock market. And we look at an intermarket analysis chart, and this is year to date. So this is the whole year taken all together, where stocks ended up performing the best, followed by gold. And then we saw the green is the dollar, where it was still up on the year, even though it's been seeing some recent weakness. And then we have bonds, that's the blue line, where oil spent a lot of 2023 being positive. It's now ended up being down on the year. Then we look at some correlations. We look at the S&P to the dollar index, and they're having a pretty strong tendency to go in opposite directions. When we get a low reading, that means opposite. When we get a really high reading up towards +1, that means they're going in the same direction. And then we look at the correlation between the S&P 500 and oil, and that's pretty much neutral right now. We look at the S&P to the 10-year, which it's coming back up closer to this neutral area, but a slight tendency to go in opposite directions. Here's the tech sector also coming up into the neutral area where they had been going in opposite directions. And we look at the shorter term yield for the 2-year, they still are having a tendency to go, the yield is going in the opposite direction of the S&P 500. And then we have some longer term charts. Here's a monthly chart of the NYSE. This is a broad market measure. We continue to go up. We're coming back and possibly testing this all-time high here, and we're above the moving average. That's positive. The Copic curve, which is a momentum oscillator, continues to be positive. And this is a daily chart of the NYSE, and we look at the NYSE record high percent index. When this is going up, that means the momentum is positive. And then here's a monthly chart of the S&P. It's above the moving average, so longer term, that's positive. And we look at the PPO, which is another momentum oscillator. It's continuing to go up as well. And then we look at the S&P on top with a daily chart. And then we take a ratio of the S&P to the CRB index, look at it in a little different way, where it's showing that stocks are still outperforming the CRB index. Then here's the S&P and another global measure that we use showing that we're above the red line, so stocks are outperforming. The KST is still negative, but this takes a long time for this to move, and we could see a cross positive here in the near future if stock prices still hold up. So then at the very end of the video, I take all the things that are positive, and my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average, and we're getting really close with some areas. So if we see some more follow-through upward action, this list will be even longer next week, where we're kind of in between right now. But we have the growth indexes. They're still in an uptrend, as well as value. That's added back to the positive side. The CRB index, even though it's been showing some weakness, it still hasn't crossed over negative yet. The dollar index, even though it's been showing some weakness, has not crossed negative. Gold is in an uptrend. The mega caps, the big software companies, the FANG index, as well as ARK, the Dow Jones Composite Average. When we look at high yield and junk bonds, they're in really solid uptrends. We're showing a lot of improvement with the investment grade bonds, but we're not quite there yet. The tech sector, as well as the semiconductors, are in uptrends, high leverage loans, the Dow, the NYSE Composite, the NASDAQ 100, and this is a new addition that was off the list for quite a while. The mid caps and the small caps are improving. We're not quite there yet with the micro caps. All stocks, looking at the US as well as internationally, and then Bitcoin is in an uptrend. And then the last list is when the 50-day simple moving average is below the 200-day simple moving average. Silver has been chopping more or less sideways and still in a longer-term downtrend. Copper showing some improvement, but still in a downtrend. And then when we look at the Japanese yen, the euro, and the British pound compared to the dollar, this could change very soon, but it hasn't quite changed yet. The low volatility ETF is still underperforming. Staples are in a downtrend, but showing some improvement. The total bond ETF, again, getting really close to a golden cross, but not quite there yet. World bonds showing some improvement, but still in a downtrend. The micro caps also improving, but not in an uptrend yet. Emerging markets showing some improvement there. Investment grade bonds as well as corporate bonds also improving, but not quite in an uptrend. So I hope you found this helpful. This is meant to be used in conjunction with the videos that I post every day. I also do a weekly video. Then after this, I'm going to do a deep dive video where I go through all the charts that I really didn't talk about over the last week. I have some new videos that I'll be rolling out in 2024 that I hope that you will find helpful. So I want to wish a happy New Year's to everybody, and I hope that you have a really nice weekend.